Welcome to this lecture on financial reporting requirements and risks. In this session, we'll explore how internal controls ensure the accuracy and reliability of financial reporting, and how organizations manage the risks that threaten this integrity. Financial reporting is the process of recording, summarizing, and presenting an organization's financial information to stakeholders, including management, investors, regulators, and the public. Reliable financial reporting builds trust, supports decision-making, and fulfills legal and regulatory requirements. The importance of accurate financial reporting cannot be overstated. Investors rely on it to assess performance and value, lenders use it to evaluate creditworthiness, and regulators depend on it to ensure transparency and compliance. When financial reports are inaccurate or misleading, the consequences can be severe, from regulatory penalties to loss of investor confidence and reputational damage. To safeguard reliability, organizations must comply with accounting standards and laws. These include frameworks like Generally Accepted Accounting Principles, GAAP, International Financial Reporting Standards, IFRS, and in many jurisdictions, additional rules under acts such as the Sarbanes-Oxley Act, SOX. Each requires management to establish and maintain internal controls over financial reporting, ICFR, that provide reasonable assurance of accuracy and completeness. Let's examine the key objectives of internal control in financial reporting. First, validity, ensuring that all recorded transactions actually occurred and are authorized. This prevents fictitious or fraudulent entries. Accuracy, verifying that transactions are recorded at correct amounts and classified properly. This includes accurate data entry, calculations, and account coding. Third, completeness, ensuring that all valid transactions are captured in the financial records. Missing or delayed entries can distort financial results. Fourth, cutoff, confirming that transactions are recorded in the correct accounting period. Proper timing ensures reports reflect the true financial position. Fifth, presentation and disclosure, ensuring financial statements are prepared according to applicable accounting standards and include all required disclosures. Now let's discuss common risks in financial reporting. These risks can arise from errors, fraud, or weaknesses in the control environment. One major risk is data entry or processing errors. Manual entries, spreadsheet miscalculations, or system glitches can lead to misstatements. Regular reconciliations, automated validation checks, and review procedures help reduce this risk. Another significant risk is fraudulent reporting. Management or employees may intentionally manipulate results to meet performance targets, influence stock prices, or secure bonuses. Common examples include inflating revenue, understating expenses, or concealing liabilities. Strong ethical culture, segregation of duties, and independent audit oversight are key defenses. Complex accounting estimates also introduce risk. Judgments involving asset valuations, provisions, or impairments can be subjective and open to bias. Transparent documentation and review by qualified professionals mitigate these issues. System and cybersecurity risks are increasingly critical. As financial reporting relies heavily on IT systems, unauthorized access, data breaches, or system failures can compromise integrity. Access controls, backups, and monitoring tools are essential safeguards. Another risk is regulatory non-compliance. Failure to adhere to accounting standards or filing deadlines can result in penalties or reputational harm. Compliance calendars, internal reviews, and external audits ensure alignment with regulatory expectations. Organizations also face human factor risks, such as inadequate training, high staff turnover, or unclear responsibilities. Financial reporting requires skilled personnel who understand both technical accounting and control principles. Continuous training and clear role definitions address these vulnerabilities. Let's consider an example. A company experiences recurring revenue recognition errors because sales staff record transactions prematurely. An internal audit reveals that policies were unclear and system controls allowed early posting. Management implements new procedures requiring validation of delivery before revenue recognition. They also automate the system to prevent early posting. As a result, reporting accuracy improves significantly. This example shows how targeted controls can directly reduce reporting risk. To maintain reliable reporting, organizations should follow several best practices. Establish clear financial policies, perform regular reconciliations, document processes, implement access controls, and conduct periodic audits. Continuous improvement through feedback, analytics, and technology keeps the control environment strong. In summary, financial reporting requirements demand accuracy, transparency, and compliance. Internal controls ensure that financial data is valid, complete, and fairly presented. Risks from human error to fraud are always present, but with robust systems, ethical leadership, and ongoing monitoring, they can be effectively managed. In our next lecture, we'll dive into the Sarbanes-Oxley Act and explore how it revolutionized internal control over financial reporting across the corporate world. Thank you for joining me in this session on financial reporting requirements and risks.